So, but I did take a break that last week of December, and you don't realize that a year of not taking a break really gets to you.
Yeah,
By the end of it, I was counting the days towards the Christmas break.
yeah. I have been on a break since August, so
Acha.
too many breaks.
Chennai, this year, that's the thing that I didn't realize. When you're at home, you feel that, it is hard to get stressed
Yes.
when you're at home.
Yeah.
But the fact is that you sometimes need to switch off. And, for that, the last week was actually really good.
Yeah. That is a challenge. Yeah. I mean, I think constantly. So I still feel that it'll be difficult for me to go back to office. However, yeah, at home there is no break, right? I mean, you're jumping from call to call, and you schedule every call because you're not traveling, you're not going out anywhere, and you have full calls. So I realized that, and in last 2 months I have not done that.
Okay.
Keep 3-4
So
hours.
for me, actually, I realized that the act of leaving the office and going home, that represents a little bit of a boundary. Even if you then work from home, at least mentally you have said, now this is when you separate the physical spaces, between work and home, then you are able to mentally also separate the two. When you're doing both in the same physical space, then there are no boundaries.
You only do extremely urgent and important work at home, right? You'll not just generally be like loitering around.
Yeah.
So yeah, I had too much of screen time, right? In fact, last 2 months I stopped doing Zoom calls also. Whenever possible, I do a phone call. Zoom call is only for board meetings and all that. Otherwise, or something like this. Just phone calls.
Yeah, I have become a Zoom monster.
And I guess that depends how your wife is.
So what's your insight there?
Well, no. I mean, that was a horrible joke. But first of all, wishing everyone a fantastic 2021, and I hope.
By the way, Rahul, by the way, wives, across the board, I've heard wives or spouses in general have been yearning for a break. Okay, so the physical act of getting out of house actually is a good act, right? I mean,
my wife is standing right beside you. I'm gonna get beaten soon.
Yeah. I think we were like really irritated at each other for the first 1 or 2 months.
Yeah, it's been stressful for some, but probably blissful for more people. But excited to hear both of you, gentlemen.
Yes, super.
Thank you, Rahul.
Yeah, we have 28 people who are excited about this so far.
Maybe let's wait a couple more minutes and see if we can cross 30.
Yeah.
Also, mere presence doesn't equal excitement. So there is also that.
यार रितेश यहाँ पे लॉग इन कर लिया अब मतलब देखो कुछ लोगों ने वीडियो भी चालू कर रखा है जैसे अविरल ने चालू कर रखा है दिस इज लाइक बिग like Rahul came and made a comment that's like a first. Okay, mostly we have to seed questions and I'm on WhatsApp with people to for them to ask questions, right? This was like unprompted. So Aviral, welcome.
Yeah, Viral.
Thank you. Hey, Ritesh, Anand.
Guys, you guys, I think in the first session we mentioned about Aviral of a junior VC. You guys remember, right? And he's here among us now. Hopefully, we'll find a slot for him to talk about how to build a personal brand and all the good stuff that he's doing.
Thanks, Anand.
So, okay. Ritesh, 31 ho gaya hai, maybe 1 more minute.
Yeah, sure. I can actually see mostly new people compared to last time.
Yeah, I think we have like 50% new, 50% same. This is a large group, Ritesh.
Got it. Great.
Probably 80 people now. Like how many registered people, Shruti?
Around 80.
Around 80, right? Yeah, slightly larger. Some people probably dropped out.
Got it.
30 people are new.
So great. Guys, I wish I could meet everyone one-on-one or at least get introduced.
We should probably do a get-together in Bangalore, Ritesh. We'll talk about it offline whenever, maybe in the next 1 or 2 quarters, whenever we get a chance.
Yes, absolutely, and we should do it both with sort of this batch and the alumni from the previous batch.
Everybody. The group is the same, and everybody's. Thankfully, most people are still there in the WhatsApp group. At least nobody's left. I think some people just depending on YouTube more than that. Hey guys, so we'll start welcoming Ritesh. Ritesh was the co-creator of this series with the rest of us last time. He has been busy, but he's here. There were some fabulous sessions by Ritesh and Priyank last time. One particular one about fund management was really exciting, and I mean, I learned a lot. So if you haven't seen it for some reason, please check it out on YouTube. Right? Over to you, Ritesh.
Thank you so much, Anand. Hi everyone. I have for today's topic, ladies and gentlemen, I have decided to pick a relatively more mundane topic. I apologize in advance for the lack of insight in the topic, but still I think sometimes the obvious also needs to be said. And I'll talk shortly about why I chose this specific topic. Let me project my screen, though, just a second. Sorry. Just give me a second, guys. Okay, you should be able to see my screen now.
Yes.
Great. So a couple of months ago, I did a little exercise on a whim, which was a little bit of a know your customer kind of an exercise. I did it because I had two hypotheses. One, that VCs live in a relatively insular world. First, I have now been a VC for 14 years. And literally from the day that I interviewed for the job, for my first VC job, there has been this debate in the VC community that who is our customer. And in fact, this was an interview question asked to me by the partner in my first VC firm. Who do you think is the customer? And unfortunately, there is no easy answer. And because there is no easy answer to that question, whether it is our LP who is our customer or is the entrepreneur our customer, we tend to sometimes take for granted what the entrepreneur wants, and tend to have certain beliefs about what is important to the entrepreneur. Because of that belief, and also there is obviously a massive balance of power in our imbalance of power in our world, because of which I think sometimes we can be blind to what our customer actually wants. The second reason is that I find there is a large and in fact increasing trust deficit between founders and investors, because of which each party is not able to whole truth to the, and because of that, the information issues in mind, I had to do a little bit of a first principle. In which It says my internet connection is unstable.
It's scratchy.
Yes, I'm so sorry, guys.
Is everybody having trouble?
No,
yes,
I think
the issue was at
some...
my end. It said my internet connection was unstable. If it happens again, I'll switch on my hotspot or something. But let's try one more time, please. Yeah. So with that object in mind, I decided to do 2 or 3 things. I spoke to a fairly decent set of experienced founders, 10, 12 experienced founders. These are people who have raised multiple rounds of capital. Some of them are very well-known people. I spoke to a smaller number of investors, about 4 investors, who have been around the block for a while. Then I also did an open survey on Twitter, plus a couple of open-ended questions and interactions on Twitter on this topic, to try and sort of gather from first principles what founders actually want. The findings I was able to collate into these 5 categories: empathy, follow-ons, processes, conviction, and value add. And this is roughly in the order of priority as I could gather from the conversations and the surveys that I ran. So this is more a distillation of that exercise. I don't know how relevant this is to the group, but since I've done the work, I might as well talk about it. And again, this is more an attempt to go beneath the surface a little bit, as opposed to only talk about what people say they want. Any questions on the methodology or the issues themselves that prompted this exercise? Okay. So I think the first thing that founders want, or this came out as the number 1 thing that entrepreneurs ask about when they do reference checks on VCs. The number 1 fear of entrepreneurs is that they will be stuck with, for the lack of a better term, stuck with an asshole. And different people framed it differently. Someone said, first look for a guy who doesn't destroy value. So before you talk about adding value, entrepreneurs are very afraid of destroying value. People are afraid of high maintenance VCs. Are you spending time running your business, or are you spending time managing your VC? And then in a slightly more nuanced version of the same argument, a couple of entrepreneurs mentioned that when things get tough, as they inevitably do in a startup, who does the VC optimize for? And they've got a very interesting framework from one of the senior entrepreneurs, that the worst VCs optimize for themselves. When things go tough, get hard, the average VC optimizes for the company, for the shareholders, and the best VC optimize for the founders. And I found that a very interesting framework from which a founder judges a VC. The other learning there was that empathy is not about actually being nice. There is a kind of VC, I have come across this kind of VC a lot in my career, who is a conflict avoiding kind of a VC. When the entrepreneurs talk about not being an asshole, I just wanted to clarify that empathy, they don't mean that empathy is about being nice. It's not about someone who's always praising you or always your champion and does not ask the tough questions. I think that kind of superficial niceness gets shown up relatively quickly in the relationship. The deeper empathy we are talking about is actually empathy which is born out of what I would call character, our conduct during bad times. So I've tried to give some examples of this, and in both my own experience and what founders tell me is that empathy comes from authenticity. That empathy comes from keeping it real at all times. And a few practical examples and a few practical suggestions, both from founders as well as this is also partly from my own experience, of how to be authentic and empathetic with entrepreneurs. I think the number one irritant for entrepreneurs is power games by VCs. So this can, power games start from the very mundane to relatively more sophisticated power games. The mundane would be, for example, who makes time on their calendar to do a meeting. If you always expect the entrepreneur, if we always expect the entrepreneur to make time whenever we are available, I think that is it's an almost how should I put it? It's the most obvious form of power games. That if we can call up the entrepreneur anytime, but the entrepreneur cannot call us up without first checking with us, or in the absolute worst cases, our secretaries. That is the worst kind of power game. But power games can also get extremely sophisticated. Creating layers of hierarchy between us and the founders is a little bit of a nuanced game. My very strong advice to all members of this group is to avoid power games at all cost. It is well known to both parties here that whoever controls the checkbook has more power in the relationship. There is absolutely no reason to project that power. To me, it is the easiest way to lose the relationship. The second piece of advice that actually came very strong from us, that both I spoke to and interacted with, was to maintain intellectual honesty above all else. We are often in situations where there are conflicts of interest for us. Examples would be conflicts of interest between two portfolio companies, conflict between a portfolio company and a new investment that we are evaluating, conflict between two investments that we are evaluating simultaneously. Those kind of conflicts actually end up destroying trust if they are not made clear and proactively. So simple things like every entrepreneur worries about whether when we talk to entrepreneurs, do we have a real interest in their company, or are we doing it as a diligence exercise for another company that we are evaluating? Making that conflict clear, reassuring the entrepreneur goes a long way towards establishing trust with the entrepreneur. I have found actually that competitors of a company that I am diligencing are far more open if I disclose that conflict right up front. If I say that I'm evaluating this company, which is your competitor, and I want views for this reason, I think I have rarely been in a situation where people have said no. But I have often been in a situation where if I do not disclose that conflict, there is I could end up destroying the relationship entirely because of my lack of intellectual honesty. It goes without saying that entrepreneurs are busy people, actually far busier than ourselves, and not respecting their time is a cardinal sin. It is something that is very hard to do because
Ritesh, just one point on this disclosing conflicts, right? Now, in some funds, as you and I both know, some of the junior folks, the associates and analysts, are actually used to find out information, right, without disclosing the conflict, right? I mean, and this is sort of probably one big reason why the junior folks are less respected in the market, right? And this is one single biggest reason I would say. How does somebody handle this, right? I mean, like your boss is asking you to do something.
So I think Anand, we must develop a spine in these situations. In the end, we must all recognize that our personal credibility is at stake. If we just fish around for information without disclosing the conflict. So
yeah, I agree.
By conflict, I mean, let's say I'm doing a diligence on company A, and I ask another member of my team to go and find information about company B, which competes with company A, without disclosing the fact that we are doing diligence on the first. I would expect out of every team in our team to be able to stand up and say that this is not right. Because in the end, I mean, think about who loses more. It is the person who is actually having that conversation who loses their personal credibility a lot more. So, so I would expect out of every team member to be able to stand up to the partner and say that this is not, I'm not comfortable doing this. And I think in our business, we have enough job security to be able to take that kind of stand. I don't think any of us will get fired for standing up and saying that this is, I'm not.
I think this is the best possible way to handle this. And I don't think that most partners actually mean harm. I think it's just that, it's easy information. So you want one more data point. And I'm sure that, most decisions can be taken with these data points, right? I mean, I don't think that these conflict situations are very, very productive also. It's not like they'll give a dramatic change in anything. Which is
Actually,
why
Anand, I have found that if we are open and direct about this, I have never been in a situation where someone says, I don't want to talk to you because you have a conflict.
Yeah, I agree.
Not just, I mean, I have a screenshot somewhere that I can share, maybe even after the call, where not a screenshot, but a number of screenshots, where I have written on WhatsApp to people that, hey, we are doing a diligence on this company. I know you are on the board of a competitor. Will you still be willing to speak to me? Will you be willing to speak to me for basically, I want to understand this industry better.
Correct.
And I have found that people don't, once they trust you, they will talk to you.
No, I agree. And Ritesh, I think talking to a board member is much better instead of doing this to a founder, because they are slightly more touchy. Right? So you don't want to do this to a founder because they have a strong memory, and from them the ecosystem has a strong memory.
Absolutely, absolutely, Anand. So I mean, to me, this is a surefire way of destroying that relationship and also reducing your credibility in the ecosystem.
Good point. I think eagerness should not take over anybody here, right? I mean, you have to think about these situations smartly, and even if under pressure, I think you probably could get the same work done after disclosing. I mean, that's what you're saying.
Absolutely.
I
think this actually many of us are guilty of. I can certainly say that I try, but in the end it becomes, it is really hard to do. Respect for the entrepreneur's time. The obvious ones are don't keep an entrepreneur waiting, and the tactical ones. The hard one is, even after we have taken a decision, sometimes we take time to communicate a negative decision.
Yeah, and even after the decision, sometimes we keep playing data, right? In Madhukar's term, playing data. So
actually, I'm coming to that. That is one of my pet peeves, to be honest. But broadly, you know, one framework I used early on in my career is that I, the same amount of I would treat the entrepreneur, or I at least resolved to treat, could not always meet that resolve, with the same considering as if this person is a partner in my firm. And that in the early days really worked for me, that framework, that if I would not keep a partner waiting for a meeting, I would not want to keep an entrepreneur waiting for a meeting as well. The easiest way to build trust in my mind is to decline clearly, which means not to say that I will, let us talk after a few months. If we mean a decline, we must say that it is a clear decline. We should say no clearly. I don't think anyone minds a clear no. Also share reasons to the, I understand that all of us are busy people and we can't write 2 pages with our reasons. But even 1 or 2 clear reasons and actual reasons that we can share while declining actually goes a long way towards building trust. I do see the downside of this, and have experienced that many times, that sometimes founders tend to start arguing about those reasons. And that is the reason many of us actually hesitate to share the reason, because it's never black or white, right? It is our judgment on whether this is a real issue or not. So again, the framework I use is that after I have shared the reason, I have no obligation to respond to the argument that the founders are giving. But that first email with ideally should contain actual reasons as to why we are declining, and also that the decline must be clear. It should not be a waffling kind of a response that where it is not even clear from reading it whether we are saying no or not saying no. I actually think that VCs earn a lot of respect when they decline clearly and with legitimate reasons.
Yeah, and Ritesh, this decline is very important. I feel that sometimes entrepreneurs don't even expect a decline because you haven't responded to the second or third mail. But declining politely, even to a cold mail, can earn you a lot of credibility. So some investment in declining to a mail where you don't have any intention to do even a call or a first interaction, even there declining politely and maybe giving 1 or 2 reasons as to why it doesn't fit. Maybe there's a conflict, maybe you don't like the space, maybe it's out of the mandate. One liner reason still is people will really respect you that you responded. Most founders, it's very difficult because we get dozens of mail every day, but 20 minutes a day could actually make you very, very respected in the mind of the founders.
Ritesh, quick question. This is Astha from Sama. One thing I've struggled with when the declining and giving a reason is, what if the reason has to do with, let's say, a poor ref check or the entrepreneur's conduct, and is, I guess, a bit more personal? That's usually where I stumble about. I don't know how to communicate it, and I prefer not to give a reason that isn't honest. So how do you handle those situations?
So very good question, Astha, and there is no right answer to this question. Sometimes if the answer is not that personal, see, negative ref checks, I think we should not disclose, purely out of respect for the person who has given us that ref check. If we go ahead and disclose, there is also a confidentiality issue there. So there the answer is relatively black and white, that I would rather not give the reason in that scenario than give the reason. When it is a matter of our assessment of the entrepreneur's competence, I do think that there is a polite way to word that in many cases, that for example, to say that given that you have not done this before, we would like to see more evidence before before committing. That sort of indirectly tells founder that that is the reason. In general, Astha, I have found that people's ego gets hurt a lot more when the reason is the team. And I would make that an exception to this rule, that either share the reason, that reason indirectly, or not share the reason in that scenario. But for every other scenario, and also what happens, Astha, is very often, even when it is a team, it is not just the team that is the reason. It is the team's strategic thinking capability, the execution capability. So then I would rather give examples of those. So this is what I did not like about your strategy, where the underlying reason is that I don't think you are good at thinking about this strategically, but it is to me it provides that balance where we are giving a real reason but not pointing to the founder's own weaknesses. Or if it is an execution, then I would cite growth or profitability as a reason that and these are examples. But this is a tough one, Astha, and I would not frame a general rule for it, but rather deal with that on a case-by-case basis.
Thanks. No, those are some great ideas. Thanks, Ritesh.
And then the last one in empathy is that we tend to, after investment in particular, we tend to sometimes get caught up in the wrapping, which is, pulling up entrepreneurs for, gaps in the MIS, or pulling up entrepreneurs for not setting up meetings on time, or what I mean the tactical stuff. And we sometimes do not realize that that is our ability to even push back on entrepreneurs on those things comes from the power distance between us and the entrepreneur. And my advice is that unless those are really hampering the business, I would actually let some of those process issues slide, because, and again, I would use the same framework. If it is not something we would bring up with our colleagues, I would not bring that up with the entrepreneurs as well. And I see this is mostly power projection, that many VCs do it only because they can, and a lot of what would constitute abuse in a colleague scenario gets passed off as I would say tough conversations in a VC scenario. So obviously does not mean that we should not have tough conversations on the substance. We absolutely should have tough conversations on performance, on business model, on team building, and all the good stuff. But I would actually, I would say that we should have a much higher tolerance for the wrapping with entrepreneurs than we do, let's say, with our own colleagues also. So on things that are superficial, the MIS didn't get set on time, the meeting didn't get set on time, the MIS is not in a format that we want. Those kind of wrapping kind of issues, my advice is to have a high tolerance for those kind of issues. The other area that really matters to entrepreneurs is our ability to follow on. And I just wanted to clarify that follow on actually doesn't mean doing our pro rata in a round. For entrepreneurs, and this came out very, very clearly in all my interviews pretty much, that follow on actually means leading. That comes, it means two things. If there are multiple investors, if there is an external investor coming in a follow on round, in that scenario, are we the first to commit? Which is, have we given a clear signal to the entrepreneur that, okay, we are raising a $5 million round. I will commit $2 million in that round. That signal is super, super important because one, it builds confidence in the entrepreneur to go and raise. That entrepreneur knows that I need to now raise $3 million. That is different from saying that, yes, of course we will invest in the follow-on round, but not giving a number, not saying will it be pro rata, more than pro rata, less than pro rata, and waiting to see whether someone else is coming in before even giving that clarity that we will actually invest.
Right. I think most funds wait to see who's coming in and at what price, what's the round. And sometimes not having an indication from the internal investor actually can really hurt the entrepreneur or the whole round, right? I mean, it drives the valuation down. It sort of can put off the incoming investor. And in many cases could actually lead to extra dilution because, the internal fund has not given a full idea of how much they want to participate. So a lot of problems. And I think this is the most important part where, founder would expect like this, usually would spend on average 12 months with you before they go to the external fundraising. So they have an expectation of some commitment of a broad amount range saying that, okay, we'll do like 1 million to 1.5 million or 2 million in this round, right? Whatever the number is, ballpark number, and sort of unconditional that we are there, we are committing to the round no matter what.
Absolutely. The people who do not commit first are the ones who will then at the end do a lot of push and pull in the round. Once the next round VC is in, then the same guy will come in who has not committed a cent before. We start saying, no, now I need more. So to me, it shows a follower behavior rather than a leader behavior. And it is perfectly okay, I think, to tell founders that I don't have the conviction anymore and I'm not going to invest a dime. Or it is okay to say that I'm going to invest only my pro rata. Or I will, I don't have enough reserves, so I'll do less than my pro rata, whatever that answer is. But if the entrepreneur knows that answer before he goes out fundraising, it helps the fundraise immeasurably compared to a waffly answer that yes, we will decide once we know who comes in and with what check size. The second one is a lot harder, which is bridging even if there is no external investor. There is no this is what the founders expect. This is what they mean when they say, will you follow on? But by no means is this a recommendation that we should always bridge, even if there's no new investor. What is incumbent upon us, though, is to have clarity, give the founder clarity on that early on. There are some funds we know who have a policy that we don't write bridge rounds, and that is absolutely fine. That as long as that is made clear to the founders upfront. Of course, this is a zero-sum game. A bridge means additional risk for the fund, and it means a longer runway for the entrepreneur. So there is no right answer here. I am more communicating that an expectation from founders is that they like firms that are open to writing bridges compared to firms that are not open to writing bridges. Once again, the only black and white guidance I would give here is clarity. Don't leave it till the last moment. Don't leave it till 30 days of cash is left in the bank to decide whether you'll write a bridge or not. It's perfectly okay to not write a bridge. It's perfectly okay to write a bridge, but give that guidance early so that the founders can plan their cash flows and the next steps accordingly. Now, obviously, as far as follow-ons are concerned, large funds have a natural advantage because they can write follow-ons more easily than smaller funds can. However, there are two issues with larger funds writing small checks. One is that it starts becoming an option value kind of a check, which means that it is easier for a $500 million fund to write off $500,000 than for Madhukar and Anand's fund or my fund to write off $500,000 because it's a real check for us. The second issue, which means that we have more skin in the game and a higher probability of actually leading a follow-on compared to a $500 million fund that is writing the same half check. The second issue is signaling risk, which is higher in the case of a larger fund. That if a larger fund doesn't do a follow-on, the startup pretty much dies. If a smaller fund doesn't do a follow-on, there is sometimes a reasonable explanation for it. So while we do all believe that larger funds have an advantage as far as conveying the intent to follow on is concerned, they do have these couple of disadvantages as well, which smaller funds don't. So in smaller funds, my advice on how to solve for follow-ons and how to compete effectively with larger funds. One is to actually syndicate in the early round, which means that even if one investor alone cannot underwrite the entire next round, two investors together can underwrite the next round sometimes. So if, let's say, it's a $2 million seed that IQ and Stellaris are doing together, between us, we can also do a $4 to $5 million Series A. Right. So while each of us individually might not be able to do a 5 million Series A, together we can. And in that kind of a scenario, syndication makes sense both to de-risk our investment and also to actually win the investment against a larger fund. Because while each of us individually might not be able to do that next round, whereas a larger fund might be able to, but together we might be able to. Second, I would say set clear expectations in terms of both as a policy, do we do internal rounds or not, so that the founder knows. But second, what it would take for them to get an internal round from us. So 6 months before they need the money, if there is a clear expectation set, or 9 months before, that if you reach this level of traction, if you demonstrate this proxy for product market fit, then we would be okay to do an internal round. That I think tells the founder exactly where you are and earns respect for the fund. And third, in the case of an external round, commit your capital first. If you do want to support the company, tell the company that I will invest in a $5 million round, I'll invest $2 million. I think there is no reason to wait for a guy who doesn't know the company to commit before you, who knows the company for 12 to 18 months, can commit your own capital. So I do think that that this is definitely something that matters, and this matters across investments. How we behave in one company will determine how other entrepreneurs perceive us. Not only because they will do ref checks with this company, but because this record is out there in the open. This record is relatively public. So these are some recommendations. Some are harder. Bridge rounds are much harder, but committing capital first on an internal round is easier. Syndicating is easier. Setting clear expectations is easier. Any questions on follow-ons before we move to the next topic?
Yeah, I have a comment, Ritesh, on this, right? So I think especially for junior people, as well as for even senior people, I think setting up the expectation with the founder is very important, because sometimes, because we want to have a better relationship, more friendly, or for whatever other reasons, we kind of keep the founder in a zone where he thinks that we are very happy about it and we will do the internal round, right? And sometimes in the past, at least in 2015-16 era, there were quite a few cases where there were commitments which were also there from the people who were involved at junior level, and then subsequently those rounds didn't come in, right? So at that time there was a big issue, right? So you have to be very clear that the founder should know that if he's not doing well, there might be a chance that we will not get the money. The entitlement should not creep in his mind that now that I have raised money from Ritesh or Madhukar, the next round, so he will give only, right? The money is there only, right? That should not be there, and that has to be very clearly communicated by looking and setting up milestones, etc., so that the founder is aware that whether he's delivering or not delivering. And don't give a false commit when you have not really discussed it within your partnership, and there is a go ahead from your partnership. Of course, you can always change if something material changes, but at least you have a say. It should not be that you have been saying to the founder that we'll do, and then when the time you go to your partnership and the partnership said, "Yeah, kyun karna hai," right? And then you next day go and tell that, "Yeah, मैं तो करना चाहता था, but my fund is not saying that ये नहीं हो पाएगा," right? And then the founder is really pissed off about that. That's very important. So you have to really set the expectations very clearly.
Madhukar, you are absolutely right on this point. We all know funds that have basically destroyed their entire reputations by not following through on verbal commitments, right? And entrepreneurs talk, and there are funds that all of us are aware of that have done that kind of thing, and that has destroyed their reputations. Also, I think if you are not able to convince your partnership on something, then either you should not be on the board, or you should not set that kind of expectation.
Yes.
Right. This is the worst kind of cop out कि मैं तो करना चाहता था, मेरा partnership नहीं माना. Then the partnership should be on the board, right? You should not be on the board.
Not only that, Ritesh, sometimes this has happened like this, and I will not name, but there are scenarios where the people who are managing the company have told the company that you reach this milestone, ये तो series भी हो ही जाएगा, मैं करवा दूंगा, right? और कुछ नहीं होगा तो मैं तो दे ही दूंगा, right? And then the founders have gone berserk and they have spent the money, expanded, and then they are like left with $500,000 in the bank account, and then suddenly the guy comes and says, "Yeah, we discussed this internally, but the team is saying that we need a lead, right? Otherwise, we will not be able to support, right?" And then the founder is stuck, right? And it doesn't even have.
Madhukar, you're right. And I think the mistake there is not saying no at the end. The mistake is in the beginning saying ये मैं करवा दूंगा, or saying that और कुछ नहीं हुआ तो internal round कर लेंगे. Now these are not loose statements to be bandied about, because what we consider a friendly conversation is taken literally by the founders, right? If we should only say we will support when you're actually sure and you have checked in your partnership and the entire partnership is supportive of making that internal round. Otherwise, it's a loose statement that will end up hurting the firm a lot more, because what we think is a statement of intent is interpreted as a promise by the owner.
Yes.
The other and the third area where founders have specific expectations are our processes. So, of course, we should all have good processes, and I talk about some of these here. But I think the biggest rule is that we are all very, very small firms. None of us has any excuse to be slave to our process. Processes are there to make our lives easier. Processes are there to make sure that there is risk management. But in small firms, that all VC firms are, it is a criminal offense to say that I will only do things this way. We are in the business of exceptions. In fact, literally every given, in our case, we invest in 1 out of 400 companies that we meet, which means that the company we invest in is an exception. Everything else is the rule. So if we can't make an exception for process for exceptional companies, then I think we will end up losing out on the best investments. which means, so we should never have to explain to entrepreneurs that this has ended up this way because of a process reason from our side. Our process is our lookout. Our process is not the entrepreneur's lookout. So some examples here, this is not an exhaustive list, of course. One pet peeve of entrepreneurs is what Anand was referring to as data earlier. That all data that we ask for should be data that is material to our decision making. We should not ask for data for the sake of asking for data. Obviously, data is important to our decision making, but let's say, the absolute worst kind of data requests are those that are standardized. And I know I might be treading in dangerous waters here. Many firms that I know have a standard template for data that they ask for this is the SaaS company template, this is the consumer company template, this is the brands template, this. I think that is a disservice to the entrepreneur. Right? It basically means that we have not spent enough time figuring out what is important in this company, and we just want a data dump. Now, हमारी तरफ से तो हमने template बना के भेज दिया उनको. The poor entrepreneur spends a week trying to fill every cell in that template. In the end, we might end up looking at, we have asked for 30 data points. We might end up looking at 4 data points out of this. And this is the reality of our business, because not everything is material. Especially if we are making early stage investments. I would say, if we look at data, in the end, 3, 4, 5 data points end up being material to our decision. Now, of course, more data is always good. I'm talking about data that will change your decision. Which basically means that I need to do my work upfront in terms of what I consider is important in this company. Is this a company where CAC is going to make a difference between success and failure? Is this a company where the marketing channels are going to make that difference? The split of marketing channels. Is this a company where the renewal rate of my B2B customers is that material? It is incumbent upon us to at least study the business model and figure out what is important before making that data request. If I'm sending that same templatized data request to every company that I meet, I actually think that I'm being slave to that process and doing a disservice to the entrepreneur. The second process issue is that, and this is a pet peeve of entrepreneurs again, is that they meet the decision maker relatively late in the process. And especially there are many very hierarchical firms in our industry, where not many, but at least a few firms are hierarchical, where first the analyst will meet, then the associate will meet, then the principal will meet, finally the partner who will take that decision will meet. Now, the hierarchies in our firms exist to make our lives easier, not for the sake of, not to make the entrepreneur's life easier. So the simple rule of thumb that I would give is that if you are meeting an entrepreneur for the second time, then the decision maker must be there. If you have not been able to convince that decision maker even to take that second meeting with the entrepreneur, then you should not be wasting the entrepreneur's time. Right? That means that the process is flawed as opposed to the company being flawed. Just one second. Sorry. Third, again, another issue that we keep hearing from entrepreneurs very often is that they have to basically, we discuss the same things in every meeting. 4 मीटिंग हो गई है, अभी आप वही पूछ रहे हो कि मेरा वैल्यू प्रोपोजिशन क्या है. Right? Entrepreneurs need to see a sense of progress in every meeting, which means that we discuss progressively deeper issues in every meeting. The entrepreneur needs to get a sense that we are understanding their business more and more with every meeting, and bringing out newer and deeper issues in every meeting, not rehashing the same issues in every meeting. And this also means that after a couple of meetings, when you do a third meeting, let's say, or a fourth meeting, we should be able to share the agenda for that meeting beforehand. That gives a sense of progress. That says that we are converging to what we consider are the most important issues in this company. If we are not able to share an agenda, and I don't mean like a very formal process for sharing an agenda, I mean a WhatsApp message saying in this meeting we want to discuss A, B, and C points. If we are not able to do it, that means we are kicking tires and we don't have clarity in our own mind as to what matters. Transparency and expectation setting is super important in this process, which means after every meeting, we should be able to tell the entrepreneur where they stand in the process. Very often this we see in our portfolio companies when they are raising their next rounds. When we talk to our founders, they have a completely different understanding of where they stand in the process. When we talk to the VC, they have a completely different understanding. I mean, the founder thinks that they are going to get a term sheet by the end of the week. The VC says that yes, we have had 3 meetings, but if all goes well, then we'll do an IC 3 weeks from now. And to me, it's the responsibility of the fund to be able to set the right expectation and give the founder a view on where they stand in this process. Sometimes our internal processes break down. Sometimes our internal, for example, we are not able to determine who in the team should take the deal forward. It has happened with us. It happens very regularly. Some internal processes break down. Someone did not share notes with somebody else, and so in the next meeting you are coming in blind. The wrong person is coming into the meeting. We realize after 2 meetings that hey, it is somebody else who should be looking at it. I think the responsibility for fixing that internal process issue lies squarely with the fund and should not be foisted upon the entrepreneur. The entrepreneur should not be required to repeat everything just because we got the wrong person in the meeting. It is the responsibility of the internal team to debrief with the right person and bring the right person up to speed. And there are many places where our processes break down, and it is okay for the processes to break down, but it should not impose pain on the entrepreneur. The internal team should take that pain of fixing it when the processes break down. And then the last one is, frankly, the end outcome is not so much in our control, but the expectation a reasonable expectation that I have found in my interviews with entrepreneurs is that for a seed stage check, from first meeting to term sheet or first meeting to verbal offer, at least a reasonable time frame is 3 weeks. 1 month is now considered too long, and 2 weeks doesn't leave enough time to do a detailed and thoughtful diligence process. This is just a guidance. We ourselves are not able to follow this in all cases, so this is more again a statement of intent and not a promise. But I found this to be a sweet spot. Founders, sometimes we hear that early stage founders expect a decision in a week. In my discussions with founders, I've found that a hasty decision actually reduces credibility of the VC. We don't want to sound, none of us actually want to be seen as cowboy investors. After 2 meetings, without doing diligence, make a decision. That can actually hurt us, even if we are saying yes to the company. But of course, speed is of the essence. Any questions on the process part? Okay. I'll move on. Just a quick. We have half an hour. I think we should be able to finish in half an hour. This is the big one. Audio companies, people are not nice people. They are assholes. They run when the things when things are bad. All of the selection criteria. Select us because we are nice people. Nobody will select us just because we do follow on. The biggest reason for selection. So the first few are screening criteria. These are the next couple of criteria are the ones because of which people want to work with us. Conviction means multiple things, and this is in order of chronology. Before we meet a company, when we meet a company, how prepared are we? How much do we already know about the market? Do we already have a point of view? Or do we have a thesis that has come not just from, that is more than just an opinion? All of us have opinions, but is that born out of research that we have done? Is that born out of an understanding of the market, having spoken to customers beforehand? I think that demonstrates conviction. That demonstrates that we are not here only to learn from the founder, but that we already have a positive point of view on the market. Actually, this takes me back also to the biggest needs of entrepreneurs in the early stage. Since the last 15 minutes, it is me and Madhukar and Anand that have been talking. I'll pose a question to the rest of the group. In your mind, what is the biggest need of an entrepreneur when they come and when they are raising their first institutional investment round? Any views? Let me repeat the question for those of you who are not paying attention the first time. What in your view is the biggest need of an entrepreneur when they are raising money? Are they looking for just the cash? Are they looking for support, partner with them? Are they looking for opinions of the VC? Are they looking for a brand that actually helps them hire better, grow faster? What, in your view, is the single biggest need of the
So what I understand, what I understand is that there are many reasons why I would look at for approaching VC. But one of which is important is that they want to know that whether the VC understands their business in depth, because that provides them a comfort whether they'll be able to actually play a long game this VC. They will help them in also approaching in the networking, that because that's the function of it in networking, and also with the follow-on rounds. That's just in short. They should have in-depth knowledge about the product, the market. That's the foremost thing which an entrepreneur looks at.
Sure. So, rather than put you all in a spot, let me give the answer that I have found through my experience. I actually think that most entrepreneurs don't raise money because they need money. Most entrepreneurs don't raise money because they need the value add. They don't even want the brand that makes it easier to run the business. I think the number one need of the entrepreneur at an early stage is validation. They want to know that apart from me, someone else also believes in my idea. It is a huge psychological need because entrepreneurship is a very lonely profession, in my view. Nobody believes in you, right? You're a bootstrapped entrepreneur. You might be smart, but you want somebody else to believe in you. I mean, maybe your co-founder believes in you, but that's about it. That's not the validation I'm seeking. So the number one thing in my mind that entrepreneurs look for is a psychological validation, that somebody else also believes in what I believe. How they get the validation through the process is if you demonstrate that this is something that you were already positive on, not something that you become positive on during the after meeting the company, but something that you already believed in to the extent that you're saying that honestly, not a false conviction. And there, I think preparedness, thesis development, and attentiveness of the entrepreneur, which is I'm really listening to you. I'm not just foisting my view on you. I have listened to you. I have understood your business, and I believe in your business. Even if we, in the end, say no, but even if for parts of the business we demonstrate that validation, I think it goes a long way towards building that relationship with the entrepreneur. The second part of this is independent validation. When I say independent validation, it is not just my opinion. It is that I have spoken to 5 people and then come to this conclusion that this is a backable business, which is what I was referring to in the previous slide, as to if I hear the downside of making a very quick decision is that you are not able to demonstrate your conviction. If I do 2 meetings, I love the business, and I just write a check, the founder is happy to get the check. But I have not been able to demonstrate my conviction in the business. Versus if I go and tell the founder after 2 weeks, after 3 weeks, this is all the work I have done. I have spoken to so many customers. I have spoken to these industry experts. I have spoken to this. I have done this research. I have written this 30-page document to demonstrate my conviction. I think the founder also knows that you're not walking into this blind. The founder knows that now your vision is actually aligned with the founder's vision. So we are able to then provide an independent validation to the founder's idea, which I think is a huge psychological need for the founder. The third way we can demonstrate conviction, is internal sponsorship. What I think Madhukar was referring to, that if I become a champion of the deal inside my firm, that demonstrates my conviction, and that demonstrates my conviction for the long haul. After I come in on the board as well, the fact that I sponsored the deal, I became the internal champion. I went and convinced all my partners and the full investment team. That demonstrates my conviction, and that demonstrates to the founder that I'm genuinely on his side or her side. To demonstrate conviction, it is important to make a decisive offer. It is important to make a written offer. So many times, founders come to us saying that so-and-so fund is in if we can find another $1 million. So then the question is, are they in or are they not in? What do you mean? They are in subject to getting another credible offer? Or so and so is in, and or if I forget about so and so, I come in and say, okay, I'm in, but we will let someone else set the valuation. What does that mean? I can't even value the company while making the offer. So a concrete and decisive offer. I don't understand verbal offers. If I'm in, then I should be able to give a company a term sheet, right? What does it mean that we are in, but I don't want to put it on email even that we are in? It demonstrates lack of conviction. All of these things to me demonstrate lack of conviction. If someone is not hungry for ownership, that demonstrates lack of conviction. I demonstrate my conviction by fighting for ownership. And it works both ways. I will not name the company, but the worst decision, the worst investment of my venture career was a company where the founder did not even attempt to negotiate the valuation. We gave the offer, the founder took the offer. Literally, there was no negotiation on the valuation, on the dilution, and it was not that protracted negotiations are always a good thing, but it should have given me a signal that the founder does not value his equity. And similarly, we demonstrate our conviction by being hungry for equity, by saying that I like your company so much that I want more equity in your company. If I say, I want 20%, but 12% is also okay, that demonstrates my lack of conviction. That demonstrates that I'm not fully in. The important thing here in this whole offer part is that you need to demonstrate that you're all in on this company. And that is not demonstrated only through words. By saying we are all in, we don't become all in, right? We become all in through the offer that we make, right? And that is why the offer needs to be concrete, it needs to be written, it needs to be decisive, it needs to be unconditional, and it needs to be focused on high ownership. We demonstrate conviction also, after investment through an upside orientation versus a risk orientation. All of us, it is our job to manage risk. But if we always talk about what could go wrong after investment, we demonstrate a lack of conviction. Of course, it is our job as board members to do a certain bit of risk management, but it is very important to not fall into that trap of always pointing out to the founder what can go wrong. When we hear a plan by the founder, if the first thing we say is, but what if this happens? What if something goes wrong? I think it's a trap which is easy to fall into because we are, 90% of the time in VC is spent on what could go wrong. That even in our portfolio, we sometimes miss talking about what could go right. This is an exhaustive list, so please give me the latitude to complete it. I think once we take the decision of investing in a company, we need to change our lens from an evaluative lens to a supportive lens. And I see many board members not being able to make that transition. And I think this hurts the dynamic with the founder. It presents us as someone who lacks conviction. If we are always second guessing the founder, always trying to figure out even after investment whether this is a good founder or not, I think we demonstrate our lack of conviction in the business. Versus saying, "Ab meri shadi ho gayi hai is founder se. Now it is my job to make the founder, even if I believe that the founder is not 100% there. Now my job is not to evaluate the founder. My job is to support the founder to make him or her a better founder." And that change of lens, I think, is extremely important in demonstrating conviction. what I mean by the next point, proactive board involvement, is that there are always two kinds of board members. Board members that manage their inbox and board members that manage their outbox. People who manage their inbox are those where the agenda for every board meeting is actually set by the founder. Where the founder says, these are my three things I want to do. And the VC gives an opinion on those things. Sometimes they help on those things as well. But always it is the founder who takes the initiative and says, this is where I want the company to go. I think the best board members are those that have a good mix of proactive and reactive management. Reactive management is basically evaluating, supporting, and helping the founder on the founder's ideas. But proactive means going to the founder and saying, hey, why don't we do this? Have you thought about doing that? What is your plan to get this new CXO? Which is basically managing our outbox with the founder. And if we are always managing the inbox, it means it demonstrates a certain, I would say, passivity. And if we truly have conviction, then we must be active and assertive on our boards. Of course, it is possible to go the other way. And I'll shortly come to that. If we are always the ones who, if we are trying to run every board meeting, I think that is probably worse than being reactive. But I do think that some amount of proactiveness on the board is very important. And the last one is, to me, actually, the easiest way to demonstrate lack of conviction is to keep asking, when can we sell? If the founder sees you always in exit mode, that in a hurry to sell, in many good companies there are incoming buyout offers on the way. If our first instinct at getting a buyout offer is let's take it, I think it demonstrates lack of conviction in the business. The best founder, I'll give you an example. In this case, I'll even name the company because it was our own portfolio company. Big Basket has got buyout offers in every round after Series B. Every round there have been buyout offers, and because in this case it's a positive example. The entire board in that company, the first reaction has always been, why should we sell? It's too early to sell. And that has given so much confidence to the founders to continue building. Now I hear that they are indeed selling. But selling at 2 billion versus selling at 200 million are two completely different animals. But I think if we keep demonstrating our willingness to sell, we demonstrate low conviction to the founder, which in the end goes into our reputation and creates a negative perception about us. Any questions, guys? I see that it's become a little bit of a monologue.
Hey, Ritesh. I had a question. Vatsal here from 100x. So, a little bit around validation, that's something I've experienced, of course, being early stage. Founders want to see you and ask you, hey, what do you think about the space? But I tend to find that I also want the founders to give me conviction as well, right? So how do you kind of draw the border between this founder is looking for validation from me before putting, before actually diving into the game versus, this is a founder where I need to give my conviction to get him on board with me, right? I mean, there'll be some founders who are just, who don't have conviction themselves and are just looking for external validation because they don't believe in themselves rather than, that they want a second opinion kind of thing.
So that is a relatively straightforward question to answer. I would not suggest investing in any entrepreneur who who doesn't demonstrate conviction in his or her own business. That conviction that is what we are looking for from entrepreneurs. If they don't believe in their own business, they will not be able to make anyone else believe, whether it is employees or other investors or customers. So that is to me, it's a deal breaker. If an entrepreneur, very often entrepreneurs, very, very early stage entrepreneurs come and say, I want to do this, but I'll only do it if I get a funding round. I walk away from those entrepreneurs, because your conviction as an entrepreneur cannot be conditional. I'm talking, on the other hand, about the investor also having that conviction. That can be optional. Good investors demonstrate that high conviction. Poor investors don't. But that is at least optional. If a founder himself or herself doesn't have conviction, then I would not touch that founder.
Thanks, Ritesh. I wanted to add a bit more color to my question. So what I was looking for is, I find that there's a thin line between founders looking for conviction from investors and founders, who have conviction, but extra conviction is always helpful. So how do you what I'm trying to understand, how do you kind of figure out who's on what side of the line? Is it, I felt that it's not as obvious as it might seem in every case.
No, you're right, and that is our job to assess, to be honest, the level of conviction in the founder. It is actually not just conviction; it's the ability to transmit that conviction to other people, which is, in a way, what all sales is. That I believe in something, and I want you also to believe in the same thing. It's not easy to assess, but it is our job to assess that, right? So our judgment might be wrong. But if our judgment says that there is even a question mark on the conviction of the founder, I would not touch it.
Gotcha. Thanks, Ritesh.
Okay, given we have 8 minutes, I will. I'll not run through the entire slide here, but there was a quote that an entrepreneur, a very senior entrepreneur, gave me that I found very insightful, that I would leave for you to read. This founder, boiled down value add to 3 parts: knowledge, experience, and network. And his point was that he hasn't come across anyone who can offer all 3. So I think the first part here is that first principles value add is table stakes. Nobody is giving us brownie points for being able to look at the MIS and say this is where your business is headed, or basically nobody is giving us brownie points for being a consultant to the founder. Second, I think it is very, very important to steer clear of negative value add, which means interference. If at any point, if you find yourself itching to stand up during a board meeting and start drawing on the whiteboard when the founder is still sitting, I would say that is a decent proxy for a negative value add. If some people have sat up, stood up before you, and people are already drawing on the whiteboard, and then you join them, that's different. But in my view, it is rather, I would rather be a completely passive investor than be an investor who interferes too much in the founder's running of the company. That said, if we can demonstrate positive value add, those are the best investors. Knowledge is really, really hard to build. Expertise is another way to categorize this. My suggestion is we should give our expertise and knowledge-based views only if we have had direct experience of that kind of situation in a similar kind of an industry. The founders most often make fun of investors by when investors get up and say, I have a portfolio company in a completely unrelated space where this went wrong, and so it will go wrong for you as well. Or you should do this because this worked in a completely unrelated portfolio company of mine. 10 years ago. So for knowledge-based value add, my suggestion is that we do it only if we have direct experience, either direct operating experience or direct board experience. If it's a situation which is analogous to the current situation, then we should do knowledge-based value add. This experience-based value add, and what I mean and what this founder also meant was this is value add based on horizontal experience that I have had. So this is not based on like this situation where my expertise is required, but I have built a business, or I have been in, from the early stage in a company that has built a business this way: horizontal business building, org building, hiring, these kind of situations. And there, I think here founders both value the help that we can bring, as well as it is possible to correlate things from non-direct experience. It might not be directly analogous, but if I have built an organization, I can actually help the founder build the organization as well. And the third is network. There, I think the nuance is that our connections are not really valued by entrepreneurs. VCs are very fond of saying, "Hey, I went to school with this guy. Why don't I connect you with this person?" It is our influence with that person that actually matters. Me knowing someone in Reliance who can be the customer of the company is actually of zero value. But if I can actually get that person in Reliance to actually sell internally, if I have that level of influence with that person, that is what matters to entrepreneurs. So we should be a little hesitant to make connections where we have no influence. The worst connections are those where we have made the connection and the other person has not even responded to the entrepreneur. That reduces our credibility. So we should make the connect only where we are sure that the person will respond and the person will actually do something to help the company. Otherwise, the connect is actually, it reduces our credibility as opposed to increases our credibility. Early career VCs can actually help most in two areas I've found: hiring and fundraising. Hiring, because very often companies are trying to hire people from the same cohort as the earlier career VCs are in. So, use your network to help hire people for the company. And second is fundraising, because early career VCs are a lot more plugged into other or next stage VC funds and can make a meaningful difference to the fundraising prospects of the portfolio. Any questions before I move to the absolute last slide?
Hi Ritesh, just a quick question over here.
Hi.
Yeah, hi. There are certain VCs who actually follow this kind of model where they kind of send one of the analysts or associates to work within the portfolio company, like kind of a secondment, right? So I kind of want to understand your views on how helpful is that? Like, how meaningful is that contribution in terms of, sending one of those for a very short period of time, usually you see, for 3 to 4 months or something like that. So like, what do you think of that?
So very good question, Shikha. I've had both experiences. I'll give you two examples. Guys, it is coming on 7:30. Whoever wants to drop off, please drop off. But if you'll allow me, I'll take 5 minutes more. So I'll give you the most famous example of this. Is Flipkart. The first time Axel invested in Flipkart was because of the analyst they had at that time, Abhishek, who now runs Traction. I've told this story, I think, last year as well when I was in some other context. So Axel had rejected Flipkart about 3 times before they invested. And during those rejections, the analyst Abhishek actually took a fancy to Flipkart. And he, on his own volition, nobody told him to, he built a relationship with the entrepreneurs and said, "I will come and work in your office." And I think the biggest, the best thing that Axel did, for which I would credit the partners, is to let an analyst go and work in some random company's office where you have not even invested. for 3 months at a time. So he would go and spend 3 days a week in the office and build the, Abhishek actually built the SEO engine of Flipkart, which ended up being the driver of growth. And because he was spending that much time in the Flipkart office, every few months he would bring it back to the partners and say, see how much progress they made. Now do you want to invest? Now do you want to invest? And eventually, to sort of get him off their backs, Subroto and Prashant decided to invest in Flipkart. And so that is a case of like huge positive value add by an analyst who was able to not only basically build the entire SEO engine of Flipkart, but also actually get them their first seed investment. On the negative side, I'll give you my own example. Early on in my career, literally my first year in VC, I got in a way seconded to this company. And I would find I had all these amazing ideas, and I would find that the founders would resist because this was not a value add that I was proposing to the founder or the founder had sought. It was a value add that was imposed by my partner who was on the board of the company. And there was a lot of resentment. I mean, I would find that the founders would not even share information because there was a lack of trust there. They felt that I was put in that secondment to learn more about the company from inside in an evaluative kind of a manner. So that actually I spent not full time, but I would say a couple of days a week over a period of 2-3 months, and it was a disaster. So broadly, there is no easy answer. I would say if I were to put it in a framework, it is if it is driven by the analyst and by the founder, and it is driven by a business need that the founder has identified and has asked for the analyst to be on secondment, or if it is driven by underlying interest on the analyst side and the analyst has directly been able to convince the founders that he or she can add value, I think then it is fine. But in most cases, it is an imposition by the senior people in the team, and in those cases, I think it is doomed to fail. So I would be a little skeptical of that kind of value add.
Thanks.
I think I would like to comment a very short comment here. I think for value add is a kind of a transaction between the founder and the board member or the investor, right? For any transaction to happen, trust is the most important thing, right? So therefore, you have to spend some time to earn that trust, right? So don't rush into value add because you might be thinking that's a value add. It might be imposition on the founder, and he will not say it to you on your face because he needs money or he has already taken money. He's under obligation. But trust building takes time, right? So give time, and given enough time, you will get your opportunities to build the trust. And once you have the trust, then there's a lot of give and take which can happen where you can add a lot of value and it will be appreciated as well. So just be patient. I have seen most of the time people are very much rushed to value add. कि अभी invest किया अभी 2 महीने में सारा value add कर देना है एकदम like quota है, I have to value add immediately, right? So take your time. It takes time for founders to open up, to trust you, and help them on small things which are not even value add, right? Just very small things, right? Keep helping them on small things, and then one day they will ask for the big help also from you, and then you will be able to put that in your CV, and you become the big friend of that founder if he succeeds.
Absolutely, Madhukar. I think every VC, at least when we start in VC, we have a CEO fantasy. We want to be the CEO. So we want to help the founder not on the small things, but on the CEO things.
Yeah.
Right. And I think your point about small wins is super that to build that trust, it is important to actually demonstrate the value in something really small. If I'm good at analysis, maybe I can proactively do MIS analysis and not use it in a board meeting to evaluate the founder or to do a gotcha to the founder, but to actually go and help him and say, hey, have you thought about this? And I noticed this and I noticed that. Or if you can introduce them to one customer or one investor, small value add pieces where you can actually demonstrate the win. I think that is far more important than adding value in what I call CEO projects.
Yeah.
Last slide on this, common complaints of founders. I'll not. I mean, some are pretty straightforward. We should not reach out without context when we are reaching out to a new company. We should at least figure out what the company does before reaching out to the company. In the first call that an early career VC will have with founders, try not to make it a templatized Q&A that I ask everyone the same questions and I'm impatient to get direct answers. Listen to the entrepreneur. Please, resist the temptation to be prescriptive in the first or the second call. It is, I mean, we are all smart people, and sometimes we are right, only sometimes. But even if we are right, we should resist the temptation to tell the founder what they should do. There will be a time to tell the founder what they should do, but the time is not the first or the second meet. We will destroy our credibility by telling the founder that we know better than them how to run their own business. Like Madhukar had or Anand, I think, had said earlier, don't share the information about that portfolio company outside the firm without their explicit consent. We should, one pet peeve of entrepreneurs is that, junior team members control their access to senior team members during the evaluation process. I think all of us have that temptation. You'll find that by actually facilitating that access rather than controlling that access, we earn a lot more respect with the entrepreneur. And lastly, our decision making itself can sometimes be careerist. We sometimes do things that are not just driven by returns for our fund, but by our own career advancement needs. Please resist that temptation. Please understand that our career will be advanced a lot more by making good investments or recommending good investments than by sort of game playing. If I do this investment, it's a small investment, so I'll have more of a role to play. This is a relationship which is likely to be more of the partner, whereas this other entrepreneur is a young guy where I can have a direct relationship. So let me prioritize this second investment over the first investment. Those are short-termist, careerist decisions that we all sometimes end up making. But if we are aware of them, aware of these biases, hopefully we'll make fewer of those mistakes. And the bottom line is that we, as an early career VC, our job is to be an ally of the founder and not a gatekeeper of the founder. And we must maintain that lens while going through the entire process with the founder. That's it from my side. Thank you so much, and please, I'm still here for now. Please do let me know if you have any further questions.
Just had one question. So you get super lucky, and you get a firm in your portfolio that becomes a unicorn or a decacorn or something. Does the relationship with the founder change? I mean, how does that work? Like, let's say there's a big fund which can throw in like $1 billion in your portfolio company. How do you sort of scale your relationship with the founder or the entrepreneur then? Or
it's a good question. It's a very good question. That the founder also, the board dynamics change over time. And just like we say for founders that what got you here will not get you there. It's the same thing with board members. The value that we were able to provide in the 0 to 1 phase, we might not be able to provide value in the 1 to 10 or 10 to 100 phase. And I think it is important to realize that. What I do personally is, as the board grows, I start to pick areas where I will spend time with the entrepreneur. In the early stages, I might be able to help them with everything from product management to org building to sales. But as the organization grows, I know that my ability to add value in sales is now zero. There is another investor who is much better at business development, who has much better relationships than I do, who is a better salesperson. The organization doesn't need so much help in product management anymore because they've already found product market fit. So maybe my main role with the entrepreneur now is to help them with org building, where I still can add value. So one is just an identification of our own strengths where we can add value. Second, it's actually okay to not add as much value in the next phase as in the first phase. So then I transition from being someone who helps to just being someone who listens. The need of the entrepreneur to have a shoulder to cry on, that never goes away. So I might be just an ally at that point. I cannot add any value, and I genuinely believe that about myself, that once a company crosses a Series C kind of a stage, my own ability to add value to that company is very low, because I'm a more specialized early stage investor. Someone else from a late stage fund can add a lot more value at that point. But what doesn't go away is my ability to support the entrepreneur. So I think it is more about self-reflection and figuring out what you are good at, and continuing to be the shoulder to cry on, because that I find that entrepreneurs have the best relationships with their earliest stage investors, because at an individual level, we have seen the entrepreneurs through tough times, and that means our ability to be that ally still is very high, even if our ability to actually add value to the business might be lower.
Understood. Yeah, that's super helpful. Thanks, Ritesh.
Hi, Ritesh. I had a quick question. Just wanted to get your thoughts on this. That naturally, a lot of founders want a quick and easy diligence process. How do you think of this giving rise to like lower standards from the VC side, where the founder also mistakes the lack of thoroughness as conviction?
So very good point, and I think this is where actually processes play a role, Jay. I think this is, I will highlight two things. One is process and the other is culture. The role of processes inside a VC firm is actually risk management. It is to ensure that we don't get tempted by our own biases. We don't get tempted by the need to win a deal. Just because it is competitive, we should not cut corners and take a poor decision. And that is why processes exist, which is why our investment memos exist. If I have not done enough work, my investment memo will be shallow. And if my investment memo is shallow, I will not be able to get it through my IC. So I do have a healthy respect for processes within a VC firm. But I think even inside a VC firm, I think culture eats process for lunch. The only way to avoid the kind of trap that you're referring to is a culture of excellence within a VC firm. It is that is both individual and collective. Individually, it means that we need to hire people who are who do not tolerate shoddy work, who do not give shoddy work. It is a matter of internal pride as an individual for them, but also that we question each other as a matter of culture, without without hesitation. If someone has turned in shoddy work, then there needs to be a culture of openness that allows us to question each other and say that this is not acceptable. What is the proof that for your belief and for the conviction that you built? So both of these are actually internal to the fund. They need not actually be exposed to the entrepreneur. You don't need to. I think Madhukar was referring to this, that the worst thing to say to an entrepreneur is, I am convinced, but my IC is not convinced. It means that it's a failure of our own internal sales. I would much rather say that I'm not convinced than say that I'm convinced, but my IC is not convinced, because I have not been able to build a case for my IC to be able to make this investment. So sorry, I'm mixing up a few things, but broadly that is what internal processes and internal culture is for, to be able to avoid falling into these kind of traps.
Actually, when you're managing a deal, right, the most important part of the point person is to basically keep the communication very clear and the expectation absolutely right on spot, right? So the founder should be aware that the decision has not been taken, right? And whatever you say at that point in time, you are a part of that decision, right? So if it doesn't go the positive way, you can blame the partner for it, but you can't get away from the fact that you are not able to pull up the deal. So the founder is not going to feel very good about you and bad about your partner. It's never going to happen, right? So it's better to communicate in a slightly homogeneous way, so that you say that, okay, I'm trying to understand. Maybe I'm not able to convey. Maybe I'll get you another meeting, right? That all you can do. But you cannot say that I am convinced, but my fund will not invest, right? That will not work. That will never work.
Yeah. So under promise and over deliver rather than the other way around.
Yeah.
Any other questions? Great. Well, thank you so much, everyone. I really enjoyed it, but I hope you get some food for thought. I'm always available to take your questions, have any discussions on any of these topics. So please do reach out to me. Twitter, LinkedIn, email, everything is fine. Thank you so much.
Yeah. Thanks, Ritesh.
Thanks, Ritesh.
Yeah.
Thank you.
Okay. Thank you, guys.
Thanks, everybody.
Okay. Bye.